Right. Good night, everyone. This is your boy Sean Jamat here. Basically, we just using the opportunity again to add more information, to add more knowledge to the team, and just welcome everyone who was able to make it. And would like to, as we say, we basically displayed. We're gonna get into understanding candlestick patterns and how that could assist us basically make more informed decisions about what trades that we're going to enter, right? So, and everything that we are doing here with Forex is about increasing our probabilities of, which particular trade to execute. So, as I always say, trading is 50-50. You could either do a buy or a sell. But what are the things do I need to see in order to make an informed decision, or have one side of of the options be much more to my favor? How can I increase the 50% chance of a buy to 90%, or the 50% chance of a sell to 90%, so that could be confirmed and based on a logical analysis that yes, this is a good opportunity to get into, to buy or to sell. So this is something that you would not find in the IML Academy. This is something that we, based on our experience, based on things that we have done, our own research, our own development, and we realize that this particular technique or this particular understanding of reading charts, really adds and gives more strength to the confirmations we do. And by itself, it's not something that you can rely on wholly, meaning that some of the patterns that you're going to see, some of the setups you're going to see, some of the things that basically you will see that will explain what these Japanese candlestick patterns mean, are not wholly or solely by themselves the only reason why you should enter, buy or sell. These things align with other more stronger confirmations and add, like we say, increased probability or increased confirmation of why we should get into that particular trade, right? So just for namesake, as we start, we're going to get into Japanese candlesticks. This is something that a technique that was developed via a very old, between the time of, I think, the 16th and 17th century. If I am correct, the guy's name is Mr. Munishima Homa. I will see if I could share my screen so that at least you can have appreciation for who am I talking about. Right, so this guy, Mr. Munishima Homa, he basically was in the 16th and 17th century in Japan, was a very, very wealthy rice trader, and he developed this technique, having the ability to monitor contracts that were done for, basically monitoring the supply and demand from people who needed rice, from the suppliers of rice. And this I want to say, during his lifetime, he made an equivalent of 10 billion by predicting the rise and fall of rice in that market, right? So he created this method, and it's only in the 18th century, or maybe in recent history, 19th century, someone from the Western world or in the US basically, found this information and decided to publish it and make it more apparent to the techniques that he does, right? So what you're going to get into is basically, what are these candlestick patterns? What are these Japanese candlestick patterns? And pretty much when you get started understanding these patterns, it pretty much starts here. As I call it, the candlestick anatomy. This is one of the most very basic things you will learn in the IML Academy, to understand what does the candlestick represent and what it's telling you. And all a candlestick does, it gives you the price action, or how price moved within a particular point in time with whatever market you're looking at, whether it be currencies, stocks, commodities, other markets. We trade on different time frames, from 15 minutes, 30 minutes, hour, daily, 4 hour, etc. And once we have found our style of what we are comfortable trading with, we know that this particular candlestick could price move within that particular time, right? So if you understand the position or the structure of a candlestick, it pretty much is a collective of a few things. Something called the opening price, something called your low price, something called your closing price, and your high price, and pretty much, and most importantly, the body of the candlestick. So if you look on the left, where you're seeing a green candlestick, for ease of eyes and for what you have been accustomed to, we use green to signify a bullish market or a rising market, and red to signify a bearish market or a market that is selling, right? And when you look at the a bullish candlestick, you will see the base of the body of the candlestick is where your opening price. So basically, at whatever point in time this was, if this was an hourly time frame, the new hourly candle that opened, the base is the price the market opened at. Then it decided to push lower, where you see what we call the wick. Some call it the shadow, some call it the tail, you know, but we call it the wick. There are different ways, different names they are called. So it basically opened at this price at the base of the candle, pushed to the lowest. So this was the lowest price within that time frame the market reached. It then this continued to push all the way up to the highest price the market reached, and then closed. Right, so that is how you read a bullish candle. The horizontal line, which represents the base, this is the opening price. Within the first few minutes of that candlestick, it pushed to this low, which is the tip or the end of the wick. Then the bullish pressure in the market was so strong, it pushed it all the way back up. All this is happening during that particular time period. So this is happening, let's say if it was an hour, happening in the space of an hour. It pushed all the way up to the highest price and then decided to close a little lower. So this is how you understand a bullish candlestick. Then bearish is the same thing but in the other direction. So the top of the candlestick body, which is this horizontal line to the top, is the opening price. So this is the price the market opened at when this new candlestick appeared. It decided to push a little bit higher, where you see in the tip of the wick or the tail of the wick, or just to the very top of this wick, and then pushed all the way down to the lowest point, the lowest price in that particular time period, then close a bit higher. So it's just the opposite, right? So you have your opening price, market decided to make a little push up, but the bearish pressure, the amount of sellers that are in the market at that point in time, you know, put the momentum in a bearish or selling direction, pushing this candlestick all the way down, and then finally closing at this price before the next candlestick came up, when the next hour started, right? So, you know, we always use, you hear us using the terms bulls and bears, and this is a market terminology that represents where buyers are dominating the market as bulls, or bears meaning where sellers are dominating the market. And for every single time a candlestick appears, it also represents who this tug of war. There's a tug of war going on in the market, you know, at every particular candlestick that appears through the market while the market is open. And every time a candlestick open and closes, wherever it closes, whether in a bearish or bullish direction, will just give you an indication of who won this tug of war during that particular time period, right? So this is just a simple illustration of what that means. So you see the vertical line in the middle was where the market opened, and you have your high side, your low side, and pretty much just because the candlestick, if this was a candlestick and closed like this, it shows that there's indecision. No one is really dominating the market at this point in time. The bulls, sorry, are not overpowering the bears, and the bears are not overpowering the bulls, right? So this is a simple illustration of this talk of what is happening all the time, right? So some of the formations or candlestick patterns you would see, you know, basically go from anywhere of these 6 candles, right? You know, sometimes don't let the color confuse you. We are accustomed using green for bullish, red for bearish, and in some spaces they use white for bullish and black for bearish, right? So just keep that to consideration. So pretty much candle 1 is just an illustration of a bullish candlestick where it has a very nice strong body, nice size body, and 2 short wicks. The bearish one, number 2, same pattern but just in a bearish direction. Then we have number 3. Number 3 is somewhat, you know, there's not much movement within that particular range. You know, there's a battle or this tug of war going on between the buyers and the sellers, and pretty much you have very short movements, whether it be in a bearish or bullish direction. In this illustration, bearish being black, bullish being white. Then we have number 4. Now these particular patterns are very, once you understand the significance of that particular candlestick, this is how you read it, you know. So we understand that this particular candlestick, white in this case, in this example, means it was a bullish candlestick. So reading it as a bullish candlestick, the horizontal base of the body of the candlestick, this very short body, was the opening price. So let's say if this was an hour time frame, this new hour started, this was the opening price, and within that first few minutes of the hour, the market decided to push all the way down to this low. Right, this is where this long wick ended up, just to the bottom of it, or the tail of the wick, or the end of the wick. It pushed all the way down. But as the market progressed into this new hour, this is when the candlestick may have been looking bearish, but during the progression of this hour, buyers enter the market and basically push this candlestick all the way back up to the tip, to the top, which is your highest price for that particular time period, where you have the short wick. And just as that hourly candlestick closed to create the new hour, it closed a little higher. So seeing that price action happening lets you know that right now at that moment, even though within that hourly time frame there was some bearish momentum, buyers end up entering the market and forced it all the way up. So when you see these patterns happening, is a good indication of that the buyers in the market, or the bulls in the market, are having the power or leverage, right? Similar thing with this bearish version of this fourth simple candlestick formation. Pretty much same principle. You had the market opening at the top. It rose a little bit to the where you see the short wick to the top. Then bears enter the market, heavy sellers enter the market. It pushed all the way down to the lowest price for the day. And as the time progressed through that hour, as that hour ended and a new candlestick closed, the price closed a little bit higher, but overall it closed lower than the market opening price. So even that too, even though buyers at last minute tried to force that candlestick up with an upward momentum or a bullish momentum, the bears in the market still had the power during that particular point in time. Then 5 and 6 is pretty much the same thing, but an inverted version of it, right? Number 6 is something we call spin tops, where you just have even wicks on both sides of the candlestick body and a very short body. All it will really represent is that even though there might be a little more bullish strength at that point in time, or bearish strength at that point in time, it points to some indecision. The market really doesn't have any strong direction, right? So based on these simple candlestick formations, we could identify in the larger picture of analyzing the market what these things indicate and what they could point towards with respect to changes in trends, right? So one of the first formations in the market we would look for, or we see a lot, is what we call the spinning top, right? So this is the terminology it's given, similar to like 5 and 6. You have your bearish, your bullish spinning top. You have a bearish spinning top. Pretty much very simple, very short body, similar wicks to the top and bottom. So you have your opening price for the bullish one below. It decided to push all the way down to your lowest price, then pushed all the way back up and closed in a bullish direction. Same thing on the bearish direction in the opposite direction, right? But when these particular patterns or this particular candlestick formation happens at the top or at the base of a trend, these things give us the ability to see or to indicate to us that there is a reversal coming or a change in the direction. So the examples below where we have spinning tops is that we had a uptrending market for some time. So let's say each candlestick represented an hour. So over a 4-hour period, every hour on the hour, we were continuously progressively rising, and at the top of that trend, this spinning top formation appeared. So basically, you had this tug of war, this struggle going on between the buyers and sellers, and after this candlestick closed with a very short body, the sellers took over. And right after, you start seeing strong bearish momentum into the next direction. So seeing things like these happening in the market give you an indication that a potential change in the trend is coming. Conversely, on the other side, the bullish reversal, same thing. You had dominantly from left to right, you had a bearish direction leading into this particular pattern. Then same thing, you had buyers and sellers pretty much having a tug of war at the base or the end of the base of the trend or the lowest point of this bearish trend, and then progressively turn into an uptrend, pointing towards a train of trend in a bullish direction, right? So next, we have something called the doji, right? So this is you'll hear a lot of Japanese terms, and pretty much a lot of the times when you see these patterns, it really represents serious indecision, no apparent direction. No one has any dominant position or direction at that point in time. or they would look like crosses. Sometimes the bodies of the candlestick may be a little more revealed, but generally they are like flat lines, straight lines. So you have pretty much a price opened and closed right on the same spot, right? Would it be at the bottom of a trend or the top of a trend? So within the doji pattern, there are generally 4 basic types. One is called the basic doji or neutral doji. One is called the dragonfly doji. Basically, a horizontal bar to the very top and a very long wick below. So all this means is that, reading it as is, the horizontal line or the base of this body, it decided to push all the way down. But then when sellers or buyers enter the market, it pushed back all the way up and practically closed right where it opened, right? So there's no apparent direction. Conversely, on the other side, with the gravestone doji, just in a similar fashion of a bearish, and then there's a long-legged doji, which is similar in feature, same structure, but just the wicks are much longer, much prolonged, right? So based on where these particular patterns or dojis appear in the market, we could have an indication of what the market is showing us that a change in the trend is coming, right? So one of the first features of applying the dragonfly doji, this is an example where, sometimes you see that if you look from left to right, we had a little bearish momentum, we had a small downtrend, then we progressively move higher and higher and higher. Then we had a strong downtrend again. And right at the base of the downtrend, we had pretty much a small top, even though we had a short wick above, a long wick below. And because of this formation, it shows the indication that a lot of buyers enter the market. Why? Right? So if we go in with the indications, number one, you had a nice downtrend leading into this dragonfly doji, a long lower shadow or a long lower wick. So don't get too confused with the word. They will use shadow, tail, or wick. We use wick. Small to no upper shadow, which is the wick on the upside of the candlestick body, and close approximately as the same price where it opened. So when you see a candlestick like this, after a bearish move, you know that the candlestick opened at the top, the price opened above, pushed all the way down, and then when buyers entered the market, it forced it all the way back up, and then decided to close just where price had opened initially. And then as you see, as you move to your right, after you start seeing other candlesticks, showing some indecision yet again, and finally it starts to move in a bullish direction. So this is always used in connection with what is happening before and what is happening after. Not just because you see this happening means that it's going to go bullish. So you always look to see what the next candlestick that forms after it does before you make a decision about entering. And as you would see in this example, you have had almost 4 candlesticks where you're having some indecision happening. You basically have a long-legged doji right here. You have something like a spinning top. You have something like almost similar to the dragonfly doji or the graveyard doji, right, which is the other version. You're having a next long-legged doji. So all this lets you know that buyers and sellers are struggling, and eventually buyers, overcome the market, and you had a nice little uptrend move, right? So the next one is the dragonfly doji, the gravestone doji. So pretty much you will see these things appearing on the peak or the upside of a trend. So you had a very strong uptrending market, indicated by number 1. You had a long shadow, upper shadow, or as we call it, a long upper wick, small to no lower shadow, or small to no lower wick, which is at the bottom of the candlestick body, and it closes approximately to the same price where it opened initially. So pretty much you had this particular candlestick open at the base. At the top, it decided to push down a bit. It pushed all the way back up, and then eventually closed just where the market opened, right? And right after, you got this strong red bearish candlestick. And because you saw this, you waited for the following candlestick to give you that confirmation. You could confidently enter the market on a sell and get the downtrend progressively over the next hours or days or whatever your time frame you're looking at, right? So like you say, you always take into consideration what led up to the doji, and most importantly, to confirm where the market is going, look what is happening directly after, right? So the next one, the basic doji, where we have the neutral one, and the long-legged version, same kind of stuff. You could see pretty much had a nice, strong downtrending or bearish market. You had this long-legged doji right after this long red candlestick, representing indecision yet again. And we even had a small little uptrend, nothing definite. They didn't really give you a big indication that there's a big trend change coming, but it progressively headed lower again, and then had another doji, and we had a strong green candlestick moving up, right? So even in these moments, you had, even though this uptrend wasn't too large, you still had the ability to take an opportunity to make some short profits right in that space of time. But a lot of the times, I like to use these dojis, or like to see them on longer time frames, H4s and daily time frames, because when these things appear, whether it be at the bottom or around the area of support, and it happens at, or let's say in an uptrending market, happens at an area of resistance, and you see these formations happening, it gives you much more confidence to enter a stronger trade, whether it be a buy or sell, right? So next, what we have is something we call star patterns, right? So these star patterns similarly, set up in with respect to if it's doji spinning tops, but they must have all three features, three key features, I believe. One of the three key features is, one, whichever is the initial direction of the market, whether it was bearish or bullish, it must lead to a short-bodied candlestick just after. But most importantly, the candlestick would open either much lower than where the last candlestick closed. So you have a bearish pattern forming here, a bearish market. So you had some nice strong momentum going lower. So after this last candlestick, the market closed at this price, but the next candlestick that formed open and close much lower. And because of having a short body, short wick, similar to like a spinning top, what I'm going to be waiting on now is to see the next candlestick basically open just above it in a very strong, nice bullish move. And what happens is that when you have these three things lining up, you get what is called a morning star. So the only time something or these candlesticks create a star pattern is when this middle or indecisive candlestick opens much lower in the sense of a bearish market, or if it's a bullish market, it opens much higher, opens and closes much higher, right? So this is the illustration on the right. It's just showing you that, like, if you try to add up the movement of these three candlesticks into one, it basically would show you this. So this was the ultimate high for this point in time. This was the ultimate low. So you have a high, you have a low. You had a strong bearish momentum down. You had a nice little short bullish candle up, and you had a next bullish candle up. So this, if you add the distance or the distance in price between these two and this, it would basically is similar to looking like this. So you can, if you watch it closely, you would see basically that is why this illustration is here, right? Then conversely, on the next side, the morning doji star is basically you have a very, very, very short body or no body at all. The opening and closing prices are pretty close to one another, and the wicks on the upside or the low side is very, very, as we call it, short, right? And the only time morning stars appear is when it happens at the bottom of a trend, right? When it happens after a bearish move. So after a bearish move, that formation happens, you have a bullish move to the upside, basically indicating, this is a good opportunity to get in for a buy, right? So, this is an illustration again of the morning star pattern. You have a very strong downtrend, or all these red bearish candlesticks. Then we had, this last bearish candlestick, a very nice body, short wicks. We had a gap down. So you see that the next candlestick opened and closed even lower than the last candlestick. Had a very small bullish bearish candle with some short wicks, and the candle right after gap up basically opened a lot higher, small candlestick, and had a very strong green or bullish move. And having seen these three things happening at the bottom of a bearish move, it gives you the indication that you could enter for a buy. And as you would see, moving from left to right, you would see just after this green candlestick form, you had a little, as we call, consolidation, but over time, the market progressively moved higher and higher and higher in a bullish direction, right? So you would see these formations happening a lot in the market. And like I say, when you see these things happening on higher time frames, there's a lot more stronger confirmation about what to do next with regards to that particular pattern. And I like to see these things happening at support levels in the sense of a bearish move, and at resistance levels in the sense of a bullish market that is going to change trend into a bearish one, right? So this is the evening star. So basically the opposite of the morning star, where that short candlestick to the middle, to the top, or the doji happens to the very top. So you had a strong uptrending market, strong bullish candle. Then you had a gap between the strong bullish candle and the next candlestick, where again you had a very short body, short wicks, and then the next candlestick, or the third candlestick, had a very strong open and close below in a bearish direction. And as you see with the illustration, if you try to join these three together into one candlestick, forming what the price action would mean is that, you know, this is what the illustration would look like, meaning that you had a very strong move all the way up to this high. This was their lowest point for the day, but the market decided to close at this price because of the type of action and price movement they're getting. So once you're seeing all these three things happening at the top of a trend, this is a very strong indication that it is a good time to enter on a sell. And like I say, I like to see these things happen at resistance levels. You know, so once you have a strong area of resistance and this happens, that adds confirmation to your analysis to say, you know what, you can jump in for a sell. Right, so pretty much the evening star, once you have a pretty short body, short wicks, is the evening star. The doji is when you have relatively no body, similar closing and opening price, and short wicks above and below. Right, so in our illustration here of the evening star, we have been having some nice, you know, movements in the bullish direction, and then we had. This is similar to the dragonfly doji, where we have a very long wick to the top. The gravestone doji, where you have a very long wick to the top, short wick below, very short body, but before it and after it, had a very nice strong bullish candle, and then a very nice strong bearish candle. And when you see this formation happening, you know now is the best time to enter for a sell, and especially if it happens around an area of resistance. You know, you could sell all day, and as you would see, as you look left to right, after the formation happened, you had a very nice, strong downtrending move. You know, pretty much you could have secured some good pips there, right? And the next pattern we're going to go into is something we call the engulfing pattern, right? So this too is another candlestick formation that again indicates to you when a trend is changing to really show you when to buy and when to sell, right? So before, while we saw the dojis, where we had to wait for three things. We waited for the strong bearish. If it's a bearish market, we wait for that last candlestick to be a strong bearish one. We wait for the second candlestick to open and close much lower than the bearish candlestick preceding it. Then we wait for the third candlestick to open a little higher than that small candlestick in a strong bullish direction. And these three together will give you a confirmation it's time to buy. Now with the engulfing pattern, you're going to be using two candlesticks. So again, if you're starting with a bearish moving market, you have some bearish candlesticks moving lower and lower. And then as the last candlestick illustrated by A, this figure A, or this black candlestick, the next one that opens, B, has a very strong bullish momentum, but basically engulfs, or as we say, covers the entire bearish candlestick preceding it, right? So how we see that, we could simply see that after this bearish candlestick open and close, and this new one happened, again, it opened at the base here, the base or the body of the candlestick was the opening price. It pushed a little lower, so it basically opened much lower than the last bearish candlestick. It pushed all the way above it and closed above it, right? So the high and low are much greater than the high and low of the previous candlestick, right? So this is a bullish. So once you see bearish candlestick, the bullish one engulfs it or covers it, you know this is a strong indication of a trend change to do a buy, right? On the bearish side, similar thing, but that's in the opposite direction. You have a strong uptrending market, some nice bullish candles, and then when the next candle opens, it opens much higher. it and closes much lower in a very strong bearish momentum. So basically engulfing the previous bullish candlestick, right? So these are two simple patterns called engulfing patterns, right? Whether bullish or bearish, right? So in some examples of what they look like, so pretty much you see, if you look from left to right again, we had a nice little uptrend. We entered a channel where it was downtrending over a period of time, and I had at number 2 this red bearish candlestick. Then at number 3, the gap down, which represents where price opened in the next candlestick. So price opened here, and then you had a very strong bullish move and closed above. So as you would see, the high of this candlestick is above the previous high of this red candlestick, and the low is lower than the low of this candlestick. So this 2 candlestick formation right here showing you that the bullish candlestick engulfed or covered this bearish candlestick is an indication of a trend change or opportunity to buy. Right, so a lot of times you would see this around support resistance. So in this case, you would like to see it around support. You would see it when a trend is changing. You may see that in between double tops. So you know, this is something, again, like we say, will always add additional information and layers to your analysis, right? So this is not defined in stone. Just because you see this happening all the time is going to mean it is going to go up, like in this example. You know, we always use this in combination with other stronger forms of analysis, right? So the bearish engulfing, similar thing but in a different direction, right? So pretty much we had a nice little uptrend, we move into a downtrend, then we entered a little channel where we're having some strong uptrending taking place, as illustrated by figure 1. You know, we had some strong bullish candles. So the last bullish candle was number 2. You had a gap up, meaning that when this third or number 3 candlestick opened, it went much higher than where the last bullish candlestick closed. It pushed up a bit, then flushed all the way down and closed lower than the low of this last candlestick. So anytime you see this red bearish candlestick preceding or coming after a very strong bullish candlestick covering the highs and lows, this is an indication of a trend change in a bearish direction, or basically the opportunity to enter for a sell, right? So that's simply how you interpret the bearish engulfing and the bullish engulfing. So next, there's something called the hangman, right? So pretty much again, this is another candlestick pattern that will happen. Basically, again, all the candlestick is doing is showing you exactly who is dominating the market at that point in time. If the buyers are dominating or the sellers are dominating, right? So normally when you see these hangmans, they would have very short bodies to the top, pretty much no wick or relatively no wick at all, and a very long wick below. So what does this mean? You open, if it's a bullish hangman, you open at the base of the candlestick. This was the opening price. It fell all the way, or price fell all the way down to this low, and then when buyers entered the market, it pushed it all the way back up and closed at this high, right? So when you see these kind of formations happening, you know pretty much that the uptrend is strong. That when this happens within a trend, that the uptrend is strong. And conversely, on the other side, if it's within a bearish trend, you will open at the top, push all the way down, and even though buyers enter the market trying to force it all the way back up, you know, overall the net result of buyers and sellers in this tug of war meant that sellers still won. So it closed in a bearish direction, right? So a lot of the times you would see these formations happening, like you would see time and time again, at the very top of the correction of a trend, or around resistance lines, around areas of support and resistance. And pretty much once you see these things happening, you know, it could give you an indication to look forward to a change in trend, right? Like I say, a lot of the times these things really have a lot more impact when you look at a little higher time frames, because you may be able to get much more pips long term than if you try them on 30 minutes or 1 hour charts, right? So as you would see here, as illustrated by number 1, you've had pretty much a nice you know, interim uptrend, and at the top of it, you see you had something like a spin top. Then you had this this hangman, this bullish hangman forming. Basically what happened is the market opened at this low, at the bottom of the candlestick, it pushed all the way down, then pushed all the way back up and closed higher with a short body. That's why it's green. And right after that, you have had strong bearish momentum moving into the future, right? So this is the opportunities when you see hangmans forming at the top of trends or the top of corrections. You know, it could be indicating a change in the trend, so opportunity to do a sell, right? So then now we have what we call the shooting star or inverted hammer, which is basically the opposite formation of the same thing we saw before, right? So before we had our opening price, which was the ultimate low, had no wick below. It pushed all the way up and then closed with a short body. When you look at the bearish candlestick in the inverted hammer, what we are seeing, we had our opening price to the top here of the body. It tried to push all the way up, but when sellers enter the market, it pushed back all the way down and closed at this ultimate low. And as you would see, as a feature of this inverted hammer, is little to no upper shadow. Or sorry, this would be lower shadow. Right? This area here, little to no lower shadow. Then the shooting star, pretty much the same thing, right? Alright, so in an inverted hammer, as you would see, again in the next example, we had a strong downtrending market, very bearish, as we see illustrated by number 1. And then number 2, we had this inverted hammer happening at the bottom. So we had this bearish candlestick, the price opened a lot lower, closed at this low, then the next one gapped up, opened in a nice little bullish, a short, small bullish candlestick, and pretty much within this, with whatever particular price in this market or point in time, you know, it was giving you an indication that the direction of this market is going to change, and you have the opportunity to enter for a buy. Right? So you see down, number 1, that's the downtrend. Number 2, upper shadow at least twice as big as the real body, little to no lower wick or no lower shadow, and real body bullish or bearish, right? Which is this is the body here with the reveal body after it closed. And it's better if this was bullish, it will be much better, right? So if it was bullish, it just shows you that at this point in time, buyers are getting ahead and would be a great opportunity to enter for buy. Right? So then the shooting star is pretty much the same thing, but happens to the top, right? To the top of a correction, to the top of a trend. Right? So you had a nice uptrend going, you had this shooting star, as we call it, happening at the very top. Same features. It doesn't really matter what preceded it, but most importantly, once it happens at the top of a correction, you know, you look and see what the market reaction is after. And as you see these strong bearish candles moving down, you know that, you know, this was giving you an opportunity to enter, or at least pointing out to you that you can enter for a short-term sell. Right? So you had the uptrend, upper shadow at least twice as long as the real body. And you know, your real body is either bullish or bearish, and if this was bearish, or in this case it is bearish, it is a much stronger indication that yes, this short-term uptrend is about to change and it is going in a bearish direction, right? So you had the inverted hammer, the shooting star, right? Then the next one we have here is called the tweezers, right? So the tweezer top formation is viewed as a bearish trend reversal pattern seen at the top of uptrends, and the tweezer bottom formation is viewed as a bullish reversal pattern seen at the bottom of downtrends. So like I said, you would see the common thread with all these combination of patterns, whether it be 3 candlesticks, 1 candlestick, 2 candlesticks, it always happen at the top of an uptrend or at the base of a downtrend, right? A lot of times what makes it stronger is when they happen. If they happen at the top of an uptrend, it's just at the area of resistance. When they happen at the bottom of a downtrend, it's just at the area of support. And it gives added confirmation to the decision they're going to make. So the tweezer top, as we say, formation is viewed as a bearish reversal at the top of an uptrend. So the common features you would see is that some nice strong bodies, low or short wicks below, and pretty much a flat closing price or opening price in these examples, but with pretty much no wick at all at the top, right? No wick, no shadow, no tail, whichever one works best for you, right? So once this formation happens, you had a nice uptrend, had this candlestick happen, then next this candlestick happen, moving progressively down, you know, this tweezer top formation is showing you that there's a trend change coming, so there's an opportunity to sell. Then tweezer bottom happening at the bottom of a downtrend. So you had a nice downtrend in market leading to this red candlestick. Then you had this green candlestick happening just after, with the base of them or the bottom of them pretty much having no wicks, just truncated or cut off like that. You know, is another indication that they're going to get in for a buy. Right? So tweezer top, sell, tweezer bottom, buy. Right? So this is our next example. This is a little example of what a tweezer top looks like. Pretty much like you would see within this time frame, we have been having some nice strong uptrending movement with all these green candlesticks. And to the very top, you know, you have had these two candlesticks that created were pretty much almost of the same size, one bullish, one bearish. If you join those two together, you would practically see like a flat line. It hasn't gone anywhere, right? So if you were able to change the time frame, so this time frame is Euro USD on a daily time frame, and if for whatever the reason you might have been able to do like a 2-day time frame or something, you might have been able to combine these two, and it would have been pretty much like a doji or something like that, right? But just looking at it for what it's doing on this time frame, in this example, which is a daily time frame, this is a very, very, very strong indication of a change in trend coming in the direction of a sell in a bearish move, right? The tweezer bottom, same thing as we said again, you had a very strong downtrend in market, as illustrated by number 1, strong downtrend. The last candlestick very bearish, little to or no wick at the base of this candlestick. The next candlestick that opened, pretty similarly same, almost same in height, same in length, same in price structure. It might open and close a little higher again, but seeing this at the bottom of a downtrend shows you that this is the prime time to enter for a buy, right? To take advantage of a buy or the change in trend. So next is our next pattern that we have is the harami pattern. Pretty much this word harami is a Japanese word for pregnant, right? So as you look at the illustration here, when you have a bullish harami or a bearish harami, you would see that it's similar to like that engulfing candlestick before, because remember when we looked at the engulfing candlestick, but just the difference is that the larger candlesticks happen first, right? So it's almost like this is the body of the female, and it falls within this price range of this candlestick, almost like it's in the womb, right? So that is the word that they use to illustrate that for whatever the reason, and it gives you an understanding. So in the previous or in the past, we touched on the engulfing candlestick. So if we had seen the green candlestick first and then this red candlestick after engulfing it, we know that this is now an indication of a change in the trend to the downside, the opportunity to sell, right? But when these particular patterns happen, the harami or as you call it, the bullish and bearish harami, you know, this is how it looks. So one happens before the other, right? So don't get confused with them. So in the sense of a bearish harami, so you would see that a bullish green candle with a long body is followed by a weak bearish red candle. This implies a decrease in the bullish momentum. So what we have been seeing from left to right, we have been seeing we move from this low to this high, to higher low, to higher high, higher low, and last push up to another high. And right after this candlestick open and close, the next candlestick opened lower than the last closing price, and it opened and closed as a bearish candlestick, basically within the body of this previous bullish candlestick. So when you see this happening, you have a strong bullish candlestick, then a very short bearish one right after, basically within that price range. That is an indication of a bearish harami, right? So when you see that formation happening, you know it's prime time to look for opportunity to enter for a sell. And that's in this illustration. This was a perfect one. If you had entered for a sell, you basically had all this downtrending taking place progressively into the future, right? So then you have the bullish harami, right? So even within a trend, within an uptrending market, you would see these formations happening because why? You had a nice strong uptrend. This red candlestick here was just a correction after the strong uptrend, and right after this candlestick opened and closed, and the new candlestick came up, it opened and closed with a very short body. It formed a bullish candlestick, very short, but within the price range of the previous candlestick before. And having seen that, you have a bearish first, and then a short candle, a bullish candlestick after, within that range. these two candlesticks right here just giving you an indication that this is a nice opportunity to enter again on a buy, trading with the trend, trading with the uptrend. So you had a bullish trend, and this illustration just showing you that if you want to have a nice area to buy into the market, you know, this is a safe price just above the high of this candlestick, which is not too much because it was a short candlestick, and you could pretty much capitalize on the uptrend thereafter, right? So that will pretty much cover the Haramis, both bearish and bullish, right? Then we have something called the Harami cross, which is the similar function. When it happens to the top of an uptrend, tells you that it is a downtrend coming or a change in trend. When it happens at the base of a downtrend, change is coming, opportunity to buy. But the only difference is that the candlestick that opens up after whichever candlestick, whether it be from a bullish trend or a bearish trend, pretty much forms like a doji. It is very short. Short wicks, short body. The opening and closing price is pretty much very close, but it also closes. It also ensures and closes almost in the same direction of the previous candlestick. So you can see I had a strong bullish candlestick, and this one, even though it was very short, it closed green in color, meaning that in that moment, all the buyers and sellers in this tug of war, the buyers still had the one up, right? And in the bearish version of it, at the base of a downtrend, similar fashion, buyers and sellers having this tug of war, and the bears in the market still had leverage over them. So when you see these formations happening, again, it's indications pointing out to you that there's a change in trend coming, right? So next, this is one that I personally don't see all the time. This is something, again, you could always go over, you could look at it, comb through the markets, and you would basically be able to see these things happening a lot. And if you were able to pick them up, because this is a pictorial thing, the more you see it, the more you look at it, the more naturally to you it will come, where you just look at a chart and you would see it happening. And in this dark cloud cover, in our illustration, he has white meaning bullish, black being bearish. If you look at the first candlestick, we had our opening price, the base of the candlestick of a bullish candlestick. We had the lowest price for the day, which is this short wick below. It pushed all the way back up, the highest price for the day, and closed just below the highest price, right? So then preceding that, when the next candlestick happens, so following it, you have an opening price like a gap. It opens much higher than this candlestick, even its highest point in that particular point in time. If this was an hourly candlestick, this was the highest price it reached within that hour. This bearish candlestick actually opened much higher. It pushed up for a bit, so the highest price it experienced during that period pushed all the way down, the lowest price it experienced, and then it closed. But as you would realize, where it closed pretty much more than 50% of this candlestick, right? So if you're looking at the top to bottom as 100%, and you look at this bearish candlestick and you look at the how low within this range it fell much greater than 50% of the body of this candlestick. So if you were to cut this in half, you would see that here it closed much lower. And as a confirmation, once you get a nice bearish candlestick thereafter, this again is yet another confirmation of getting an opportunity to jump in for a sell, right? So again, this is another illustration of what it looks like. So you have your strong bullish uptrend, your prior uptrend. You opened at this price, you push all the way down, your lowest price for that at that particular point in time. It pushed all the way up, closed at this high. Then the next candlestick that appeared opened at this high, way above this candlestick, pushed to the high. This is the highest price it experienced within that time frame, pushed all the way down and closed here. And as you would see, it basically closed much lower, much more than 50%, or penetrated much more than 50% of the body of this bullish candlestick. So anytime you see this take place, again, is another indication at the top of a trend for opportunity to enter the market on a sell, right? So in the example, as we are seeing here, a nice little uptrend. We had a correction to the trend, this nice red bearish candlestick. Then we had the next green candlestick opened at this price. It pushed down a bit, the lowest price for the day, pushed all the way back up and closed much greater than 50% of this red bearish candlestick. And after seeing that, You could wait for the third candlestick to open and close in a nice bearish candlestick, bullish candlestick, and you could jump in for buy and ride it all the way up again. And then conversely, again, we had another one. You know, when this happens below, it's called a piercing cloud, I believe. I'll have an illustration of this after. And when it happens at the top or the top of an uptrend, it's a dark cloud cover, right? So the most important feature is at the top of an uptrend, you had a strong uptrend, strong bullish candlestick. Then the following candlestick that opens much higher than that bullish candlestick and closes more than 50% of the body of the bullish candlestick. Then you had a nice strong downtrend leading into the future, right? So the PSN pattern is the opposite, right? So the PSN pattern is basically when it happens, as we see in this illustration, at the bottom of a downtrend. You had a nice little correction. Sometimes we always have trends within the trend. Overall, we had an uptrend starting from this low to this high. We had a correction, and on the correction, it could be around an area of support. You found this PSN pattern happening, again, giving an indication of an opportunity to buy with the trend, right? So that is pretty much it, the PSN pattern, right? So if you want to look at it in terms of what it may mean, if you look at it or you combine it, this is something like I was indicating in some of the examples previously, or blending the candles. You had this nice bearish candlestick, the strong bullish candlestick, and if you combine the two together, it comes like, you know, you have an overall view of that range of the highest price and the lowest price experience within the combination of those two. You would see this was the highest price during the day, this was the lowest price during that time frame, but it would have closed much higher, right? So basically all this is trying to show you is that is what happens when you see a hammer pattern. When you see this hammer or shooting star, it basically means that this was the formation of some candlesticks that created that one. If you see this hammer pattern on a 1 hour time frame, and like let's say you go down to a 30-minute time frame, more than likely you will see two candlesticks like this. Because remember, every 30 minutes would represent 1 hour, right? So whatever candlestick that is open right now as the market is running, whatever currency looking at, you drop down to a 30-minute time frame, you would see two candlesticks. And more than likely, if you're having this pattern form in a hammer, and you go down to a 30-minute time frame, you will see that the reason for it is because you're having two candlesticks that are fighting against one another. A very strong bearish one and a nice strong bullish one, right? So you had your PSN pattern. Anytime this happens below, strong bearish move down, strong bullish move up. You have your PSN pattern, and when it happens at the top of a trend, or top of an uptrend, we have a dark cloud, opportunity to sell, opportunity to buy, right? So then, as we come to almost to the end of it, this is one of the patterns that sometimes you see a lot, which is called the three black crows. So simply, you have a very strong uptrending market. You have a strong, you know, as you come over to the tip of that trend, or as the trend starts to change, what you're going to see is that at the top, the candlestick that opens and closes above, preceding it or following it, sorry, you would start seeing some uniformed bearish candlesticks forming. You would see there would be up one particular size, the other one would be a little longer, the other one would be a little longer. And when you see these three progressively strengthening bearish candlesticks, this is a pattern that they call the three black crows. I really haven't researched how they got to that name, but when you see this happening again at the top of a trend, you have to wait for these three candlesticks to really show you that yes, once you see these three candlesticks, now is the opportune time to enter for a sell, right? So just an illustration of what the three black crows continuation pattern looks like. You had a very strong uptrend. You're seeing hammers and dojis and inverted hammers and all these things taking place. And what you start seeing after this bearish candlestick close, you almost got something like a tweezer top. And what you saw, you start seeing a bearish candle, strong bearish candle, strong bearish candle. And after seeing that formation, these three progressively strong bearish candles, that is your confirmation to continue into this market in a bearish momentum or looking for the opportunity to sell, right? So this is what the three black close would look like in a bearish market. Then on the other side, when you're looking to buy, they call it the three white soldiers, right? So just basically the opposite. right? You had a very strong downtrending market. It closed the last candlestick just between the trend range. It could have a short body, it could be a doji, it could be a hammer, it could be anything that represents indecision in the market. And what would confirm that this uptrend is starting is you need to see these three white, or as we say, it could be green if you use green as your color for a bullish market. Uptrending candlesticks moving larger and larger. So you have your first candlestick, the second one is a little bigger, the third one is a lot bigger. And once you see that happening, it gives you the indication that the uptrend has started, and pretty much you had a strong opportunity to enter the market for a buy, right? So this is what the three white solias look like in a practical example, where you're having a little downtrend taking place. It led up to this three candlestick formation of the three white solias, and now after seeing that formation happening, you had a very strong confirm opportunity to enter the market for a buy and go up with the uptrend, right? So pretty much, guys, this is all that we wanted to cover. At our parts very quickly. I tried to really get this done within an hour time. The nice thing about these things again is that these are not telltale signs. These are not formations that is exactly going to tell you every single time you see it you're going to do a buy, you're going to do a sell. But the best thing about these things is that when they line up with your basic analysis, you learn support resistance, you understand the trend, you're waiting for pullbacks, you're looking for price reversal zones, everything that we learn as we go through the academy. And when you see these formations happening at a particular price you're waiting to do a buy or a sell, that adds that added confirmation to increase the probabilities of your winnings or your ability to earn profits in the market, right? By simply applying some of these techniques. And also, if it is that you want to review it, you could go to Google. There's Google candlestick patterns. There will be many different images where you could get some nice pictures. You could keep as reminders of every single pattern you could refer to, because as you see it more and more, as you practice it more and more, and you start analyzing the market, start watching the charts, you're going to start seeing these patterns and get more familiar with it, so that in the future, when you're doing your own analysis, it won't be foreign to you. You would know exactly what to do when you see these particular patterns happening, right? So that's pretty much we'll cover it for tonight, guys. I just want to say thanks for coming out. Thanks for taking the time to look at the information yet again. And like I said, this is something that is not in the academy. This is something that Mr. Arnell Grant introduced me to, and having learned it, it really adds much stronger confirmation to what we do and why we do what we do here at iMarkets Live, really and truly. And it is not the telltale, it is not the only thing you can use, it is not the only thing you must put all your hopes into. But when you use it in combination with all that it really strengthens your bias with regards to what trade that you're going to do, right? So once again, guys, thanks for coming out. We don't want to keep you any much longer, and we hope to see you at the next session when we have another training every Wednesday at 7, right? So we're trying to keep this going, and we're keeping the value running, we're keeping the education going, and I hope this added some added knowledge to whatever it is you'll be doing right now. So thanks for your time, and enjoy your night.